ahead, my next guest has first-hand experience of the inner workings of the US Central Bank and an informed view of what will actually be driving the debate at Jackson Hole later this Friday. Andrew Popper, CIO at SG Hambros, joins me now. Hi, Andrew. Thanks for joining us.
Good morning, Mark.
What's the message that markets want to hear from central bankers in Jackson Hole this weekend?
Well, I think what they want to hear is that relaxed and easy monetary policies will continue. Quantitative easing will continue. The virtual zero interest rate policy will continue. And I think that message will come across regardless of the speculations that maybe Mr. TRICHET will have a somewhat different message from Mr. BERNANKE. I don't think that will be really the case. There might be some nuances. Maybe they have decided to divide the role, the good cop and the bad cop, and talk a little bit about the possibility of exiting quantitative easing. But I think that generally there is significant consensus as far as monetary policies are concerned. So there won't be a lot of debate as far as monetary policy is concerned. Monetary policy, almost everybody agrees, has to stay relaxed, has to stay easy. Quantitative easing will continue. The central banks are not about to start reducing significantly the size of their balance sheet. The major debate that's taking place is about fiscal policies, and certainly they will be discussed in Jackson Hole.
But they don't have
much
control. Influence,
exactly.
Do they? So
they may have some influence in terms of expressing ideas, influencing policymakers, but they certainly do not have control. Fiscal policies are established independent from the central bankers.
And we know what happened when Alan Greenspan got involved in government policy, not just fiscal government policy. He was castigated for that, wasn't he?
Well, this is true. And certainly central bankers have an influential voice. They will be listened to, and policymakers, people who make fiscal policies, will be listening very carefully. So it is important. I'm not trying to diminish the importance, but the ultimate decision is not a central banker's decision. And in that respect, I think that the move towards more fiscal consolidation is inevitable. And in my view, it's a good thing. I think that the fact that we are moving away from relying entirely on fiscal stimulus to provide economic growth, it's a good thing. Certainly there are some risks related to it, but I think that the best possible combination of economic policies is to continue to inject reserves into the system, to maintain low interest rates, to make credit available in the system. In other words, very simply to allow money supply to growth, or to create the conditions for the money supply to growth, but at the same time to reduce the fiscal stimulus and allow the business sector to pick up
in this environment,
slack.
Andrew, though, how as an investor, when you're looking at all these various asset classes, when the talk is that the global economy could be heading towards either sluggish growth or a double dip, how do you invest your money?
Well, certainly although we do not believe in the double dip scenario, and we do not believe that there is serious reason to see deflation in the system, we still have to be very cautious because the market participants are focusing on sluggish economic growth, on the economic growth stalling in some places. So we are very cautious as far as investing in equities, because the equity markets remain under the influence of a lot of conflicting factors. So we are underweight in equities in our portfolios.
Do you like bonds still?
Yes, we still like bonds.
Government bonds.
We're still in government bonds. It's very hard to still expect capital growth in the bonds, but still the bonds are a respectable investment. There is still value in the corporate sector. That's very important.
Andrew, I've got to move it on, but thank you for joining us today. Andrew,
Thank you.
From SG Hambros.